Okay, so for those of you who might not know me, I'm Jay Taylor. I write a newsletter called Jay Taylor's Gold, Energy, and Tech Stocks, and I host a radio show now for 10 years called Turning Hard Times into Good Times every Tuesday at 3 o'clock Eastern Time, 12 o'clock Pacific on the Voice America Business Channel. And you can listen to my podcasts as well. If you go to Jay Taylor Media, they're always posted there, and YouTube as well. So I started this year thinking that we were probably going to see the end of an equity bull market. And the year is almost over, so it looks like I may not be right on that call. But the question then is, where do you go if the big equity bull markets are over with? And most people go to treasuries. That's what we see on risk-off days. And they've been going to gold. But we haven't really had a real substantial gold bull market where people didn't go to treasuries. They only went to gold, except back in the 1970s. And I remember that well. That was right after gold was detached from the dollar, and there was a great deal of inflation that took place during that time. So gold was kind of an inflation play. But most of the time we're seeing, when the markets are struggling, we see gold going up and we see treasuries going up, rates coming down. So the big question is, are we ready? Is it possible that we might have another situation like we had in the 70s? That's my question in a way, in a nutshell. Well, if we look at the performance of gold, I did some numbers just a little while ago before I come down here. We see the Treasury, the 30-year U.S. Treasury is up 8.66% on the year, and gold is up a little more. But of course, an awful lot more money has flowed into treasuries than into gold, because that market is absolutely huge compared to the gold markets. And what I really think that we have to keep our eye on, it's hard to see the long-term picture. We relate to those experiences we've had most recently. And to try to look at the longer-term picture, it sort of helps when you're older, like I am. I'm 72. I've got a lot more in the rearview mirror than I have out ahead of me. I know that's true. But I can remember when we had a very substantial change. I was a young 20-couple-year-old person when Nixon detached gold from the dollar. And that was a gigantic change. It affected all of our lives more than most of you have any idea. But what that's done is allowed the central banks of the world to create endless amounts of money, debt-based money, as opposed to the gold-backed standard, the gold-backed money that we had before. Debt-based money, debt is the raw material from which gold, or from which dollars and other fiat currencies are manufactured. So what we've had is a massive creation of money and debt. The debt is growing exponentially, but the income is not. And so what you see here, and I call this the pathology of Keynesian economics, with each cycle, with each credit cycle, and they're credit cycles more than business cycles, they're credit cycles, we see lower lows and lower highs. And why is that? Very simply, they can't raise rates very much without causing the whole system to topple over. This is another chart that just illustrates the point. This is through 2015, when our Fed tried to normalize the balance sheet, so you see a little less growth of debt relative to GDP here, but you see the historical debt to GDP is growing exponentially longer term. And what's happening now, of course, is, in the United States, we've had to have lower interest rates by about 5% to turn around a recession, to try to stimulate the economy. So we haven't gotten anywhere near 5% in the US. So that means if we have to go 5% below, the US is headed for negative rates, it would seem. Well, most of the world, a good part of the world, is already on negative rates. There you can see across the board for Denmark, all of 15 plus years, most of the world is on negative rates. 94% of all positive yielding investment grade debt in the world is denominated in US dollars. So the US is the last bastion of positive, sane interest rates, even though they're not all that sane, because we're going way below the cost of capital, the real true cost of capital, I think. So Chairman Powell really tried, I think, to normalize the balance sheet the Fed's balance sheet, he really wanted to go back to normal interest rates, to normalize interest rates. And he tried very hard until he had what I call that OMG moment. That was at the beginning of this year, the end of last year, when he realized that if he kept tightening or not allowing money to grow fast enough, that we were going to head into another, probably a 2008 or 2009 scenario. So this was the Powell pivot. Just to give you an idea, here's the major central bank balance sheets. You see the EU as well as the Bank of Japan, and you see that none of them really significantly reduced their balance sheet. Chairman Powell tried to until he had that OMG moment. You can see that this is really good news for gold, as measured in dollars at least. This is a chart that shows gold's performance relative to negative yields, bond yields that are negative. So there's a strong correlation, negative yields, bullish for gold. The Dow gold ratio, which I like to look at, it gives you a sense of the relative value of stocks to gold. And when we've had these major moments of decline for equities, we've seen the ratio approach 1-to-1. This was last around 1980, the time frame that I started following gold and gold shares. Again, I just showed this again because I think it's so important. You know, the interest rates, the hikes actually are the problem. The hikes set up the next decline because it creates all this debt. And the debt is created, it's not natural. The economy can't handle it efficiently because when you shove so much money into the economy, it's called malinvestment. People do crazy things with money when it comes easy, when you don't have to earn it, when it just flows like just without end. So we have the bullion. What I say is what we're looking at is the normal yield curve, where near-term rates are lower than longer-term rates. The bullion banks love this scenario because it means that they can go out and borrow gold at 1.5% or 2%. That's pretty much what you have to pay to borrow gold. And then they can sell that gold for dollars and buy treasuries at 5 or 6%, and then maybe leverage up on that and really make a killing. And so when things are normal, that's what the bankers can do with the positive yield with higher rates when the rates are higher than gold's rates. Let's see what we got here. Okay, here is an inverted yield curve. My friend Alistair McLeod, who's on my radio show frequently, believes that this inverted yield curve is really what drove the gold price from $1,200 some dollars to $1,550 or so. Because this really hurt the gold carry trade. You know, they could no longer, when the yields on treasuries were below the cost of borrowing the gold, it didn't work very well. So he thinks a lot of this was an unwinding of the gold carry trade that took us to $1,550 or so. Now, Alistair's also talked about the importance of negative yields for the world's reserve currency. He points out that there's a big difference between the euro or the Japanese yen having negative rates in that all of the commodities around the world are priced in US dollars. So what happens if the yields on US dollars fall below, fall so far below what he calls the time preference? You know, if you think about it, you'll lend your dollars out if you get a certain return on it. You have in your mind that you need 2, 3, 4, 5%, whatever it might be, but collectively the market has a number in mind that isn't allowed to be realized by the Federal Reserve and the central bankers who do not allow the natural interest rates to occur because they're all trying to bring us heaven on earth without having to work for it. So Alistair's point is this, that when interest rates fall below what the time preference is for gold or whatever you have, all commodities have a time preference too. It's worth more to own that commodity today than it will be in the future. So his point is that if we go into negative yields, if the US dollar goes into negative yields, it's probably game over for the dollar as the world's reserve currency. That's his view. There's a lot of other factors that coming into play too. But this whole issue of time preference is an Austrian school concept. The Keynesians don't recognize it. But, I mean, just think how logical it is. You'd rather have your dollars today than have to wait 10 years for them or a year. And you're willing to let your dollars go, you're willing to let your gold go or whatever if you can get more back in the future. But if they're depriving you of that ability, then you're not going to want to own those dollars anymore. That's the point he's making. Now, a number of years ago, in January 1988, in fact, the economists were suggesting that along about 2018, it would be the end of the dollar as the world's reserve currency. And they also predicted the petro-yuan futures market really took place in 2018, which a lot of people think may be paving the way for that. Now, I saw just recently a very interesting story on comments by this young lady, Ann Coren, on CNBC, and I'm going to play what she had to say. There's a lot of dynamics that are taking place around the world geopolitically, economically, that I think are suggesting, and I don't know when, but they're suggesting that the dollar's days as the world's reserve currency may be numbered. And so let's see if we hear this, what she has to say.
I don't think you're looking at a situation where we're going to be moving from one single reserve currency to another single reserve currency. I mean, if you look historically, the fact that we have a fiat currency as the world reserve currency is kind of an outlier in terms of the history of money, right? So we don't know what's going to come next. But what we do know is that the current situation is unsustainable. You have a growing club of countries, of very powerful countries, and the major movers are China, Russia, the European Union, that have a strong motivation and a stated motivation to de-dollarize. And part of the reason is the use of extraterritorial jurisdiction by the U.S. You're subject to U.S. jurisdiction if you use the dollar. Okay, if you clear through a U.S. bank, if you use the dollar, you are not an American person, you're not working for an American company, you're not doing business with an American company, you have nothing to do with the U.S., you've never set foot in the U.S., you're still subject to U.S. jurisdiction. So there's a very, very strong motivation for a lot of countries to move away from the dollar.
So with that, how significant is it that we now have a petro-yuan?
I think it's a canary in the coal mine. Look, 90% of oil is traded in dollars. Okay, so if you have a sort of a beginning to crumble away of the dominance of the dollar over oil trade, that's a nudge in the direction of de-dollarization. It's a necessary but not sufficient condition for de-dollarization. But I think the petro-yuan, the reason it's significant is not so much the instrument in and of itself, it's the mindset that's behind the instrument. Okay, whether you're looking at Europe motivated because of the U.S. withdrawal from the Iran deal, Europe wants to do business with Iran. It doesn't want to be subject to U.S. law for doing business with Iran, right? Nobody wants to be picked up at an airport for doing business with countries that the U.S. isn't happy that they're doing business with. Whether you're looking at China, that in effect is one of the bankers of the U.S., right? A big holder of U.S. debt, looking at the U.S. and saying, wow, the deficit is growing, the debt is growing, it's unsustainable. However, is the U.S. going to meet its financial obligations? How is that ever going to happen? Under what scenario could that possibly happen? It doesn't matter if it's Republicans or Democrats, right? There's simply no political configuration out there where you see that this the budgetary deficit or the debt issue of the United States is going to come to a successful end of the story. So you're looking at that. You're looking at the fact that these countries feel that they're being thwarted in many ways. You're looking at the fact that, recently in an interview from prison, former Brazilian President Lula da Silva said that one of the drivers for the creation of BRICS was reducing the importance of the dollar, was reducing the dominance of the dollar. So there's a lot of motivation among powerful players around the world. And so the question is not, after the dollar, are we moving to the yuan? I don't think that's the right way to look at it. I mean, now we have emerging technologies, we have cryptocurrencies, we have all sorts of different things. So I think what we do know for sure is this situation is unsustainable, okay?
All right, what we do know for sure is the current situation is unsustainable. She named a bunch of different dynamics that are really drawing people away from the dollar. Remember Secretary of State Kerry talking about if we were to renege on the Iranian on the Iranian deal, the nuclear deal that Obama put in place, that it would be a strong, it would prompt a lot of countries to want to get away from the dollar as the world's reserve currency. She referred to that. She also referred to the idea that we're never going to be able to repay our debts. And other countries that have been lending to the United States, because we have been borrowing from other nations, it's not as if we owe this debt to ourselves, they're saying we don't want this currency anymore. It's starting to happen in a very real way. How soon it breaks down is anybody's guess, but I think the seeds of destruction are written into the Western world's monetary system that's based on Keynesian economics, that's based on money creation out of nothing, out of debt, essentially. And so it doesn't take a rocket scientist to see that things are coming to an end. Countries that own the world's reserve currency don't last forever. We've had ours now for about as longer than Portugal or Netherlands, maybe not quite as long as Britain or France or Spain, but it's getting long in the tooth. So this is something to think about in terms of owning a currency that retains its value forever. And there's nothing more that does that. There's no currency or money better than gold to do that. And just a quote from Alistair MacLeod, who basically says that the central banks, by printing money, are creating its own destruction. That's the quick version of what he has to say. They think they're solving a problem. In the short run, they are, but the pathology is getting greater and greater. And the Chinese and the Russians, which she referred to, and she's not proposing gold, I don't think that she would, but she sees the current system is nearing its end. And certainly the Chinese and the Russians and some of the adversarial countries to the United States especially have been building up their gold reserves very dramatically. Why would they do that? Because they know that gold is honest money. It never loses its purchasing power over hundreds of years, thousands of years. This is just I chart the gold price it's a monthly average gold price, and this goes back to 2000 or 1995. I did this when I was at ING Barings yet. This is a chart that I used then. As a seller of gold, you want to know what's sort of an average price. The daily fluctuations don't matter so much. But this certainly doesn't look like a chart that wants to go down, in my view. We're having a little correction right now, but it's looking pretty good. So the question really is, are we going, I don't cheer for this transfer over beyond the alligators over to gold. That's not what I want. But what I think you have to look at is the system as it exists. And nobody on Wall Street are going to tell you to stop buying stocks, because that's how they make their money. They're not going to make any money selling you gold. So you have to take these things into consideration. All right, which brings me to the people that really matter here, the companies that are finding real wealth in the ground. Actually three are up here with me now. GFG Resources, who I invited to the show, is going to be with John Kaiser tomorrow, and I would really suggest you listen to that. I think it's a very good story. That's why they're here. They have one project, one very large project in Wyoming that is being developed by a major company, and then they have some more exciting, more earlier stage exploration in Ontario. RN Resources and Ivan Bebek will be up here in just a moment, really exploring the Sombrero copper gold project down in southern Peru. Also, it has another flagship property, of course, is the one up in the Nunavut, and that is really, well, Ivan will tell you about it, but there are two major projects, but there's another one that's coming into the picture that Ivan will tell you about that's very exciting. I didn't really focus on it much until this morning when I read a recent press release. Triumph Gold is finding some major, has reported some very major intercepts into breccia pipes or porphyry-style mineralization. And Tony Barassi will talk about that. Very exciting story, very, very large system that they're looking at and uncovering. And right next door, just about 40 kilometers away or so, Rockhaven Resources, with its Claza project, is something that I think the market isn't paying any attention to, but they should, and I think that will we'll hear from Matt. He'll tell us about that in a few minutes. So right now, I'd just like to invite Ivan up to give the story on RN, which I really love very much.